Have you taken your financial blinders off and no longer trust Wall Street with your retirement? Do you want to create passive income that exceeds your monthly expenses, but realize that most of your wealth is tied up in your 401k and your IRA? In this episode, we'll discuss when you should and how you can free your money from the control of Wall Street. Stick around.
Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And like we said in the introduction, today we're going to be talking about how you guys can tap in and free up your money from the control of Wall Street. Anthony, how many times a week do you think you get asked this question?
Probably about once a day, actually.
Okay.
How about you?
Twice a day. Anthony, this is an often posed question to us, right? Is because kind of what's happened historically is people have been pushed and led into putting their money into these government-sponsored plans, and they come to quickly realize that they have no control and they have no access, and so oftentimes people are reaching out to us for a solution. Has that been your experience?
Yeah, or maybe they've read Rich Dad, Poor Dad.
Mm-hmm.
It's like, hey, I want to create my passive income to be more than my monthly expenses. And maybe they want to buy real estate or they want to start a business and they need capital. But the problem is that capital is locked up inside their IRA or 401k.
Mm-hmm.
So we're going to talk about some strategies on how and when to take that out.
Awesome. One thing we do need to state at the beginning of this episode is that this is not tax advice. We're not saying that you should take your money out of qualified plans, but if you do, we will tell you how and when to do so. Fair enough?
You know what was interesting about this is I was doing some research from here because what was interesting, original kind of title was, how do we get money out of qualified plans?
Yeah.
Right. So as I was preparing for this, I'm like, well, maybe we should include the definition of what a qualified plan is, because I think most people might have heard of it, but they don't really know what it is. And I'd have to say, I learned something on the definition of a qualified plan. And I'm sure you already knew it, Cameron. So I'm not even going to ask you, okay? Because
Sure,
I know you knew it. But did you know an IRA is not a qualified plan?
Of course I knew that.
Okay, right?
Of course.
Qualified plans are ones that are employer sponsored and they follow certain tax code from the IRS. But an IRA is an individual plan and it doesn't follow some of the same regulations. So calling this broadly a qualified plan is inaccurate. So I started thinking, well, what can we call them?
Yeah.
So I started thinking a government created plan.
Okay.
A GCP.
Okay. Well,
right?
what are these GCPs that you're referencing?
Well, yeah, I don't know if that thing's going to stick, but we will see. But what we're talking about here is really, we're kind of lumping a few different types of plans. So IRAs, 401ks, Roth, SEPs. Then there's simple IRAs, there's 403bs, 457. Basically, any of these accounts created by the government, we're kind of wrapping them around into one. And I know we'll probably be referring to them as a IRA just because we got to come up with something. And if we do a GCP, right, since we just dropped that wisdom today, maybe not everybody will understand. So as we're explaining this, I might say IRA, but I'm referring also to a 401k or a 457 or whatever.
Got it. And if you guys, right, so that is a disclaimer. There's going to be some broad generalizations here.
Mm-hmm.
If you guys have specific questions, feel free to comment. We'll address those, or feel free to reach out to us. We'll make sure we got a link in there to discuss your situation. But Anthony, let's talk about these GCPs. Right? Let's talk about these things. Why do people fund them?
You know, what I think is that they're looking for that immediate gratification of lowering their taxes today, but they have the myth that they're being a lower tax bracket when they retire.
I thought
we're going to dive a little more deeper into that, but go ahead.
No, you just referenced as a myth, and I just assume that talking to accountants throughout the history of my career that was tried and true truth, right? That was set in stone.
Yeah, you know what? And that's what I thought too. That's what they teach you in CPA school, right? And so we are going to have a section in
Cool.
there to discuss discuss that myth. But what I would say, well, or they also might do it. They might do a Roth because
Okay.
those distributions are currently tax free. And I'm saying currently because I know I'd mentioned on an episode we did a while back where I don't know what time frame, let's say 20 years. Okay. In 20 years, there will be some form of taxation on a Roth IRA.
Well,
You're already getting a 1099 for it. So the government tracking is already there. And what I believe they will do similar when they add something like a new tax or even the income tax, they're going to pick on the ultra wealthy, right? Oh, this guy, no reason why this person should have whatever the number is, might be $5 million inside there, so they're going to have to start taking it out. They will be coming after that plan. But here's the biggest problem with those reasons is people are making that decision solely because of taxes.
mm,
And taxes should be a piece of the puzzle, but I never think the sole decision on an investment or an account or when to sell it, the sole logic in use in making a determination should never be solely on tax. Tax should just be part of the puzzle, but it's not. It's not the entire piece. And another reason why I think people use these plans, these GCPs, that's all they know, right? That's what their friends are doing. That's what the advice that they're getting from Wall Street, from their parents, their coworkers, their employers. They don't really know of any other opportunities outside of IRAs.
mm,
And, they're also mandating it. What is interesting, my daughter was automatically enrolled when she was working, when she had a job a couple of years ago.
mm.
And even my son automatically enrolled, and they were actually started taking money out of his check. I mean, a lot of times you're just signing all that paperwork when you get hired and you're just kind of sign here.
Yeah.
And then he got pissed. But you know what I think is interesting? And this is a quote from our mentor, Nelson Nash, who is the founder and author of Becoming Your Own Banker and the Infinite Banking Concept. And what he had said is that lawmakers create a problem by spending money that they don't have, which results in strangling taxation. And then they create a solution in the form of an exception to the rules they created.
Mm.
So always be aware when the government's going to be there to be the savior or whatever solution they have to the problem that they created. Now, Kim, so we're gonna, before we dive in more of kind of how to take the money out, I'd like to hear a little bit more of what's your thoughts on these plans,
Well,
GCPs.
thoughts of two things. First thing that comes to mind was I liked Nelson's quote there, which results in strangling taxation. I like that adjective. And oftentimes I've described debt as suffocating, right? So you're meeting with a client and they have this debt that they've been carrying, and it's just this huge, heavy burden in their weight. And I like that strangling taxation. I'm going to steal that for sure. So you guys will hear that one again. My thoughts on plans, man, I like them, right? I love them. I want some more of them. I don't know who that was. It's a country song, but no, that's a joke. I think they're terrible. I'm not a big fan of them. And I really can appreciate your sentiment a minute ago, because I have this conversation a lot with clients as well. And it's become the default investment avenue for a lot of people. And man, you know what? Most time, more often than not, it's not any fault of their own, right? Somebody starts their industry, starts their career. HR pulls them in and says, hey, we got a great opportunity for you. You can start saving money in the 401k plan or retirement plan. And so that's what they do. And there's some problems with that. We've discussed it before, but the biggest issue is that there's no education. that comes along with that. And when people start going down that road, there is this sense of uneasiness as they have no control. They don't know what's happening. They don't know how it's going to turn out. And so that's often a lot of times when people reach out to us is they're looking for an alternative. So.
Cameron, I like how you said it's the default.
Mm-hmm.
So what people are just defaulting to what somebody else has created and is telling them to do. And rarely is that the best decision for you and your family.
Yeah. Anthony, what are your thoughts, Anthony?
Well, we could do this whole podcast on it, but in summary, totally agree with what you say in regards to lack of control, not having the education. What I'd also add, I think they're overused, right? They do have their place, and I'm going to mention that here in a second, but not everybody should have one of these government created plans, right? And some of the issues that I have with them is that you're limited on the investments that you can have inside there. They're illiquid. So when life happens, it can be difficult for you to take that money out, which means you might need to get into debt. Okay. We tell people invest in what you know. I would say 95% of the people invested in these government controlled plans or created plans have no idea what they're investing in. They're just broadly putting in some index or some sort of fund. And as we've said before, that's speculation. We need to learn what we are investing in. And probably my biggest issue with these government created plans, we can't use them to create passive income. Now, most of our listeners, we're trying to create that passive income to be more than our monthly expenses. And when it's in one of these government created plans, it's very difficult, very, very difficult to do that. Now, they do have a place, right? And what I would say before we would do one, our other ducks need to be in order, right? Maybe we've created some passive income. We have some liquidity, because really having this plan is solely a tax play, right? So once we get our other things in order, there can be a place. And what I want to take a little moment here, we're going to talk a little bit. There's two types of taxes. There's the ordinary rate, which is it's your marginal tax bracket. This is whatever tax bracket you're in. This is also the highest tax. Now, the other one is the long-term capital gains, which this is going to be the lowest. So if we're investing something that has tax advantages, or even like stocks are long-term capital gains, or if you want a business or real estate, do not put anything with tax advantages in one of these government created plans, because we start to lose those tax advantages. Now, however, there's some investments that are going to be taxed at the highest rate. I mean, whether those are like a hard money lending, people investing in mortgage notes, that's going to be in the highest tax bracket, the marginal rate. So maybe once you have all your other ducks in a row, having one of these government controlled plans to house one of those investments, I think can make sense. Right?
Yeah.
Now, Cameron, let me ask you a question. What do you think is the reason why most people are hesitant to take the money out?
No, it's the boogeyman. It's the taxes, right? Everybody gets scared by the tax bill or the tax liability that's sitting in there. So that's what scares them.
Right? Because I'm going to argue here.
You're going to be wrong.
Well, let's see. Okay. And maybe if you're watching this on YouTube or let's make a comment. Tell me if I'm right or wrong. But I'm going to argue. You don't even know what I'm going to say, and you're already saying I'm wrong. But I could argue that you will end up paying more taxes if you leave it in.
No, I would agree with that.
Okay, so I am right. Perfect. Podcast over. Cameron agrees. Now,
well, go ahead. So why would you say that?
Well, what I would say is money from an IRA. Now, let me take a moment here, because there is a Roth IRA, right? So we're mainly focusing on more of the traditional IRA or 401k. And the reason being, most people don't have Roths. And the downside of a Roth really kind of alludes to all the disadvantages that I just mentioned, but it's hard to get a lot of money in there.
Yeah.
Right. Like a Roth IRA has limits. So if you want to get 100 grand in there, I mean, it's going to take you many years. Right. And so I think most of the time we're having these conversations, it's more about more of the traditional IRAs or the government controlled plans that are pre-tax. So when we take them out is when we're going to pay tax. But back to why I would say you're into paying more taxes by leaving the money inside your IRA. And the reason being is your IRA is going to be taxed at the highest tax bracket, right? And what's interesting, most investments are actually taxed at the lowest tax bracket, the long-term capital gains. And in addition, with real estate or a business, has additional tax advantages. Right? When you have your business, you're able, I like to say, put a business spin on an otherwise personal expense. Meaning, like you and me, Cameron, we have phones, we have cars, we go out to dinner, we do some traveling, we have internet. We may pay for some attorneys and all these other things. Now, a lot of these expenses we're going to have to pay anyways. However, because we have our own business, we can put that business spin on it and we have the ability to deduct it. However, if you're an employer maxing out your 401k, you're still incurring those expenses, but you're getting zero tax benefit from that. Also, with real estate, there's accelerated depreciation. Oftentimes with real estate, because of the mortgage interest deduction and the depreciation, oftentimes we're actually showing a loss the first 2 years. So we're not paying taxes. And again, when we do sell that property, if we do sell it outright, it's going to be taxed at a long-term capital gain, or we can roll it over into another property. So we have the ability to having those tax deductions by having our own business or investing in assets that have tax advantages. Now, Cameron, let me ask you this. You think taxes are going to go up or going to go down?
Oh man, you're throwing me softballs today. This is easy, man. I think they're going up, and not only are they going up, I think they're going to go way up.
Okay, I would agree. And David M. Walker, who was a former comptroller of the United States, aka he was the CPA of the United States.
Nerd alert.
Yeah. Now, there was an interesting documentary in The Power of Zero, The Tax Train is Coming. He had said taxes are going to double because of a 4-letter word. You know what that 4-letter word is?
I do.
It's math.
Yeah.
Right? It's math, right? And one thing that I think is interesting, this Time magazine is from April 26th of 2016. And what it says here is that it says here $43,000. This is what every American man, woman, and child would need to pay to erase the 13.9 trillion in U.S. debt. Okay. Now, what Time magazine did not, nerd alert, because I'm about to throw some data here. Okay. So, what that wasn't taken into account in that 13.9 was money the government owed themselves. For example, the government will often borrow money from the Social Security Fund, or they sell them treasury bills. Okay. That's not included in the 13.9. Okay. If when we include the money the government owes itself, we're up to 19 trillion. Okay. You know what it's up to now, Cameron? What our deficit is?
I do. It's 32.
32 trillion
With the T.
with the
It's a
T.
big number.
You know, what I think is interesting, we are throwing the trillion around like it's nothing.
I totally agree. I think it's scary how
But
much money is being spent.
here's what's interesting: a million of anything is a lot, right? A trillion is 1 million millions. Like, let that sink in there. That's only 1 trillion. It's 1 million millions. I mean, it's really hard to grasp, to wrap our mind around it, right? But now what that does is that equates to $97,000 per citizen. Not all citizens pay taxes, right? Your kids don't, mine do, okay? But per taxpayer, $236,000 per taxpayer. Now, I'm looking at my family. There's me and my wife. We're taxpayers.
Mm-hmm.
My kids, my mother and father, like, we'd have to pay over $1 million from us just to get down to zero. Okay. What I also think is interesting, the numbers that Time Magazine was talking about was 8 years ago, which means our national debt increased 1.7 times over 8 years. It almost tripled over 8 years. The government is currently taking in, they have revenue, this is total revenue, $4.6 billion. However, they're spending $6.3 billion. That means the government is spending 1.7 trillion, or 1.7 million millions more than they're taking in each year.
Bro,
Okay.
this is our fast. This is super depressing. Right? Tell me that we've got another thing
Okay.
here. Yeah,
What I would say is, you think taxes are going down, you are delusional. Okay.
I agree with you. I agree with you. So let's see if we can change this topic or just kind of keep this moving so nobody's getting too depressed here.
Mhm.
Fasto, what would you say to somebody that believes that they're going to be in a lower tax bracket when they retire? That is another truth that is often communicated by traditional planners and also CPAs out there.
Okay. I would say, if you do that, you're planning for failure. And what I say that is, if you're going to be in a lower, how are tax brackets, what are they based on, Cameron?
Your income.
Your income. So what that means is you plan to make less income when you retire. That's the only way you're going to be in a lower tax bracket. Let's not only take into account the house is probably almost paid off. You know, you can no longer deduct the kids. So we're going to lose some tax deductions. But the question is, do we really want to be in a less income when we retire? I'm not even taking into account the cost of inflation, right? Now, you very well may pay much more in taxes with an IRA, but here's the problem: at the time you can least afford to do so, right? When you're in retirement, you're on a fixed income. Taxes go up. That's a huge burden for you. I know I'm starting to be depressing. We are going to turn some things around here. Okay, we're almost there. Okay, but the bottom line is that this is the truth.
Yeah.
Right. And if we know what's going on, then we're going to know what to do.
Absolutely. Awesome. All right. So we're kind of talked about some of these GCPs, where the government's at, right? They're overtaxing or they're overspending, right? What about kind of some early withdrawals? When we look at these GCPs, one of the things that we have discussed that keeps people from tapping into those is that early payment penalty, right? What are your thoughts on that?
What I would say, well, I think the question, that early withdrawal penalty of 10%, I would say, what's your penalty for keeping the money in? What I mean by that penalty could be higher taxes, because we have no idea what the tax rates are going to be in the future. Also, we're not taking into account opportunity costs, right? I think on this podcast, we've had some great guests, that had some great ways to create passive income or to build wealth. How many of those can we do inside an IRA? There's
One or
probably
two.
one or two that would be okay to be inside a GCP. But what that means is we're missing out on these opportunities to create passive income and other ways to create wealth outside of our IRA.
Okay, so we're talking about, right, some things that are holding people back, but now let's look at some of the options. What are the options to free someone's money, Vaso?
Okay, so let's start talking about some things that we can do. Now, first, I'm going to talk about 401ks. You're basically screwed, I would say, for the most part, right? Because
Surprise.
what's interesting, I always thought that 401ks that you could not um, take an early distribution while you were still working there. But during my prep for this, I realized that is determined by the 401k plan, meaning that plan could say you can't take an early distribution, but you can roll over your 401k to an IRA. Once that's done, now we don't have the restrictions that we would with a 401k. Now, so a couple of things that action items that we could do, because I know a lot of our listeners are owners of companies, and that maybe they have a 401k, maybe because they wanted one themselves, or maybe their blinders are off, or a lot of times they need them for their employees because employees need them, and that's one of the benefits that they are looking for. But if you're the owner, can't you change the plan? Right, you can change the plans so you could allow your 401k to be rolled over to an IRA. But what this also means, if you do have a 401k and you transfer to another job, they're going to want you to roll that 401k balance over. I would not do that. I'd roll that over to an IRA at least. If you're not taking it out, roll it over to an IRA. That will at least give you some more options to what you can invest in, and also gives you that flexibility if you do want to take some of that money out. Now, what most people will do taking money out is a regular distribution, right? The problem is you have to wait till you're 59 and a half. Right? And then that'll be at your marginal rate. Now, if we take something out early, and early means before you turn 59 and a half, there's going to be a 10% penalty, which we had talked about. Now, if you do this from a Roth IRA, what you put in, because that was after tax, you can take, so you won't pay tax when you take it out. But any gain, if there is one on your Roth, that gain will be subject to tax, as well as a 10% penalty. Now, here's a little known strategy where you can avoid that 10% penalty, and that's called substantially equal periodic payments. In essence, it means we take equal payments or withdrawals from your IRA, and you do not have to pay the penalty. Now we are going to have to pay the tax. Now, for me, I think the downside of this option is, again, it's some of the opportunity costs. We might want to move that out faster, right? But I think if you're over 50, as the closer you are to 59 and a half, the more I think that this makes sense, because we have the ability to spread out the tax as well as not paying the penalty. Now, however, doing this, you have to follow this to a T. You have to make sure that you make those equal distributions. So there is a risk there that you might not be able to follow through. So that is an option, but there is some risk. Okay, so that's kind of more of the some of the ways that, or more of the standard ways that we can take them out.
Well done. So that was amazing once again, Anthony. Just simply amazing. Just blew me away. What are some of the strategies that someone can use to free the money from these government created plans?
Now, first, I'm going to talk about some exceptions to the 10% penalty that the IRS already allows. Now, we're still going to have to pay the tax, the income tax, but I'm focusing on the ability to avoid the 10% penalty. There's about 7 or 8 of them. Most of them, hardly anybody is really going to use, but some ones that you can is that you can take $10,000 out of your IRA or your GCP if you're a first-time home buyer. Now, one thing we need to realize, if you look at the description or definition of a first-time home buyer, it's somebody who hasn't had a home. I don't know if it's 3 or 5 years. Okay, so technically you might have already owned a home, but then maybe you moved and you sold it, but you haven't owned a home in 5 years or during that time. You're considered a first-time home buyer. Also, another strategy is maybe you got married and your spouse moved into your house, right? And then when you go to buy maybe a house together, put it in her name, and she's now a first-time home buyer. I would tell you one little thing that we've done is, like, the house that we own is only under my name. It's not under my wife's name. Now, but before anybody starts making some comments here, we live in a community property state, so legally it's half hers anyways. Okay, so there is no benefit that I believe to having both of us on there. There's our advantages of only having one, and those advantages are, what if things get terrible and I lose the house, right? That's going to affect my credit, it's not going to affect my wife's credit. So, but she still owns it. But another thing that you may be able to use is you can avoid the 10% penalty if you have qualified college expenses. So that is probably the one that people can take the most advantage of. Another way would be every now and then we're going to have a lean year, right? Or maybe we're changing jobs or had a period of unemployment, or we took a large loss from investment. So that year we're temporarily in a lower tax bracket. Great opportunity to move some of that money so you can, you will pay taxes on it, but we're going to be paying it at a smaller rate. And here's a little story. I have a client of mine who was flipping a house, and it just did not turn out well. All right, he's going to lose. Hopefully not, but we're anticipating that there is going to be a loss. And I said, you know what? That's a great opportunity. So you're going to be in a lower tax bracket that year. Now's the time to either take that distribution. Or full disclosure, that would be the time to roll it over into a Roth IRA. But again, there are limits of doing the Roth IRA. Now, here's a pretty cool one that I like, is you can time it so you have an investment that has tax advantages, and you buy that in the same year that you take the distribution. For example, you can buy a rental property, do a cost segregation, which means they really analyze more of the detail of the house so we can depreciate it over a shorter period of time, meaning our depreciation expense is going to be higher. And we've had some clients that were able to take because of buying this rental property and using the cost segregation, they were able to take that loss. And then that was a good opportunity. What they did is they took the money from the down payment from their government created plan, and then they used that to buy the house. With this with accelerated depreciation, in some cases, it was actually more than what they took out of. It was more than their down payment. So there's a way to do some timing. Now, if we buy a long-term rental, downside is in order to take that loss, we need to be a real estate professional. But one thing that is interesting, if you have a short-term rental business, you do not need to be a real estate professional. Okay. Also, there's other investments like oil and gas. I know we haven't talked too much about oil and gas, but there's some great tax advantages of investing in oil and gas. Then I got two more ways. One would be to strategically make withdrawals to make sure you're under a certain tax bracket. Because this part I think is interesting, right? If you're married filing jointly, if you make $90,000, your marginal rate is 22%. Okay. But you can go all the way up to the 24%, the top of that, $364,000. So if we think about it, you could, if you're making 100 grand, you could take out 150 grand from your IRA, and you're only going to, instead of paying 22, you're going to pay 24. Okay. And in fact, I've got a client who had recently retired, and he did really well in the stock market. He was a real investor. Like he bought the stocks, did his research, but now he's like, man, I am highly leveraged, or not leveraged, but I have a lot of money in the stock market.
Overexposed. Yeah,
he's overexposed. So what we're going to do is kind of like the opposite of a dollar cost averaging, where he's going to start slowly taking that money out on a monthly basis, and he's going to use that to pay his premiums.
Spend down.
Now, in the last method, I call it the Bo Jackson method. Just do it. Just take the whole thing out. Okay. That's actually what I personally did when I learned about IBC, but and this was in 2009. So I was fresh off the crash. So for one, the balances were I had taken a nice haircut, but I used that funds to kickstart my policies.
Well done, man. That was thorough.
Thank you.
Right. So you guys listening, he hit several highlights there, gave some really good examples that are typically shared kind of in one-on-one meetings. But man, if you guys want to go back, listen to that. And if you have any follow-up questions to see if you guys qualify for some of those opportunities, again, feel free to reach out to us. I'll kick you over to Anthony's calendar. You guys can meet with him. Right. All right, Anthony, let's kind of wrap this thing up. We've got a couple kind of pending questions that we opened with is advantages, disadvantages of IRAs. Let's make sure we touch on those before we close this thing up. So what are the advantages of an IRA?
To be honest, I can't really think of one. Right. And most people will say taxes, but I think that they're going to be wrong.
Wow. Bold statement. Bold statement. I think it's the third or fourth one that you've made in this podcast. Right. How about the disadvantages? What are the disadvantages of having an IRA?
To me, kind of the top three would be the limited options for investments. It's still liquid. So we don't have access to those funds. And again, this is more of a personal level. It goes to your goals. I'm trying to create my passive income to be more than my monthly expenses. And that is almost impossible to do in a government created plan. Well
said. Anthony, you got anything in closing remarks before I wrap this up?
I need some water. I've kind of, my mouth is a little dry after all this yapping.
And my ears are bleeding. So, guys, if you're listening to this, you guys have questions. Again, we do have a link in the show notes. Feel free to reach out to us. Happy to discuss if any of this stuff applies to you specifically, or answer any kind of generic questions, and more so along the lines of infinite banking. But man, we covered a lot today on certain ways that you guys can tap into or free your money from the volatility of Wall Street and get away from those GCPs. Hope you guys enjoyed this episode.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out.
And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.